Hey, what's going on, everybody? I am here for Financial Fitness Friday. Dave couldn't be joining us, so I'm going to take this solely, and I wanted to go over money, right? It's Financial Fitness Friday, super important, and it's funny because I work with clients on all ends of the spectrum. People just starting their business, and then I have people that have 8 and 9 figure businesses. One of the biggest differences in what I see with how successful people are is what their view on money is. Okay. And I'm going to explain what I mean by that. People that are super successful understand that money is a tool. Okay. Money is a tool to be multiplied, to grow, to hire, to build with. Okay. Money really isn't an asset. Money hasn't been an asset since, I believe, 1913 when we got we had taxes. They formed the IRS and they formed and then when we were taken off the gold standard, right? At that point, money is not something that is savings. And I'm not saying you shouldn't have savings. I'm just telling you that money depreciates a lot over time and you lose your buying power. So the smartest people I know, the most successful people I work with, all use money as a tool, right? If you have $50,000 and you hire 4 people, those people should add a significant amount of revenue to help you make more money, have the company become more profitable. Same thing. If you don't own a business but you're looking to invest, if you buy a piece of real estate that is a rental property, you rent it out, you're multiplying your money. Now you have a hard asset and you are bringing in additional cash flow. All right. So, first off, I want to change your focus and I want you thinking that money is a tool. It's not the end all be all, it's just a tool to help you build the life that you want to build, to buy your time, to multiply. That once you focus on money being a tool, it is way, way easier to build the type of wealth, the type of life that you want. All right. And then the other thing I want to talk about is good debt versus bad debt. We brought it up a bunch on Financial Fitness Friday, and it's always worth repeating. Okay, good debt is anything that is going to make money. Okay, you're borrowing money to make more than what you're paying and make profit on top of what that money costs. Because all money costs, there's an expense to money, right? There's an expense to holding it, there's an expense to borrowing it. So, what you want to make sure you're doing is whenever you use leverage, use debt, you want to make sure that that is going to increase your wealth. Give you an example. If you own a business and you need a piece of equipment or pieces of equipment to grow, to scale, to offer new services, all right, you shouldn't buy that in cash. You should finance that. Okay. And as long as the payment is less than what the revenue is being generated on a monthly basis, you're making, that is a net positive. As long as the return on investment is higher than the cost of the capital, that is a net positive. You should move forward. Obviously, you want the best deal. But in that scenario, it works and it's helping you multiply money. Okay. Again, money is a tool. You want to multiply. Same thing with investment properties. If you don't own a business, you don't operate a business, but you want to grow your net worth, what can you invest in that is going to multiply that money? Well, hard assets like real estate. If you buy a fourplex or a duplex, you invest in it, you fix it up, you rent it out. You want to make sure that the rent cover is far exceeds the monthly mortgage payment. And if that does, what you're doing is you're bringing in positive cash flow. Okay. That positive cash flow allows you to go and repeat this process, which allows you to continuously build wealth. All right. Now, what's bad debt? Bad debt is anything that you're using that you're paying a monthly payment on, that you're paying interest on, that is not bringing in any type of return. Okay. So let's put it like this: if you were to go out and buy a new vehicle. Not that you needed it, but you wanted it. Okay, that's bad debt because that's going to appreciate. That's going to depreciate in value. Okay, for the most part, and it's not bringing in any income, and you're paying an interest. You're paying interest on it, right? It could be 2%. It's still technically bad debt. You don't need it. Okay, it's the same thing as you going and booking a vacation. Spending $10,000 on a credit card. If you spend 10,000 on the credit card and pay it all off and get the points, well, you were going to spend that money anyway. You're not paying interest on it. That makes sense. But if you're doing this to take your family away on vacation and you're not paying it off right away and now you're paying interest on it, that becomes bad debt. Okay? Student loans, bad debt. Most people do not need student loans unless you are a lawyer or a doctor. You don't want or need student loans. Okay, this is very important because making the right choices with money and focusing on money being a tool is what's going to allow you to build your wealth over the long haul. Okay, and so many people get this step wrong. It's super important. Okay, that you use it as a tool and make sure that you're always multiplying it. Make sure that any of your bad debt, credit cards, student loans, personal loans, anything that is not bringing in an income gets paid down as quick as possible. And when you're focusing on when to pay it down, how to pay it down, always start with whatever has the highest interest rate. It doesn't matter if you operate a business or you operate, you're going off of your, monthly cash flow statement as an individual. Make sure you're paying that debt down that has the highest interest rate. Once that's paid down, move on to the next tier. All right. I hope this helped you. If it did, please share it with someone that needs to hear it, and we will catch you on Mindset Monday. Take care.